Hello, trade pros, and welcome to today's video. Now, today's video is all about trading strategies for averaging down. So this is a really good video. It's really informative. But before we get started, let's just quickly play that intro. So on today's agenda, we're going to talk about what it means to average down, when to average down, averaging down using charts, and averaging down using order flow. And if you haven't already, guys, hit that like and subscribe button. You will be notified with every video that comes out. We have a video released every weekend and totally worth it. And we appreciate your support. So if you could hit that like and subscribe button, that would be great. Now, with that being said, let's get started. So what does it mean to average down? Averaging down is a technique used where a trader will purchase additional options contracts or shares of an existing position after the price has dropped to bring the average cost of their total position down. So if the underlying turns around, the break-even point of your position is lower, and therefore your gains will be larger if the underlying continues to move in your favor. So you are taking on additional risk when you decide to average down. It is important to note that. But having a lower break-even point also allows you to get out of a losing position easier and potentially avoiding a loss. However, if the underlying doesn't move in your position's direction, then you could potentially end up taking a larger loss than anticipated due to adding more premium into a losing position. So guys, averaging down, before we go ahead with the rest of this video, it is risky. It is an art form in terms of a trading art form, and you have to learn how to do it. It takes practice. But once you do understand it, it is really great for avoiding losses, for having a lower break-even point, but even more so, which is much less risky, it is great for your long-term portfolio and strong companies. So we're going to get into that a little bit more as the lesson goes on. So advantages and disadvantages. Advantages, like we said, it has a lower break-even price, is potential for larger gains, and you can end up owning shares of a strong company for a cheaper price if you plan on holding long term. And then the disadvantages, you're taking on more risk. So if your trade doesn't work out, there's higher loss potential. And also on the flip side, you may end up owning more shares of a failing company if you plan on holding long term. So we don't want that either. We don't want to keep averaging down on a penny stock that may not be that strong and just holding it forever until the company pretty much declares bankruptcy. So averaging down, you have to know when to do it. You have to know how long you're going to hold for before you take on additional risk. So that is also very important. So when to average down. So timing is important when choosing to average down. Here are the factors you should consider when deciding if you should average down or not. Are you averaging down at support? So from a technical analysis standpoint, there will likely be a bounce at support. Now, not always, but there could be. And therefore, an opportunity to get out of a losing trade at break even. So that's really important. You have to make sure that there is buying or bids coming in at support before averaging down. So you do have to wait for confirmation. But that is one way to get out of a losing trade or to potentially profit off of a once losing trade. So secondly, what does options order flow indicate? So is there order flow coming in that confirms the underlying will move in your position's direction? So that's also very important. That gives us further confirmation. So third, is there an upcoming catalyst that could affect your position? So if a catalyst is in your position's favor, averaging down may have a good risk reward. So if the catalyst could affect your position negatively, it may not be worth the risk. In that case, you may just want to take the loss and just make the money you lost back up in a winning trade. And are you planning on holding this position long term? So averaging down on your long-term portfolio for strong financial companies offers low risk, high reward strategy. So averaging down versus averaging up. So averaging up is when you purchase more shares or option contracts of a ticker you already own, but at a higher price than you originally bought it at. So averaging up is useful when you're confident that the price will continue to move in your position's direction, and therefore you want more shares or options contracts in the ticker. So even though it'll bring your average cost up, you'll still have larger gains if the stock continues in your direction because you'll have a larger quantity of shares and contracts. However, averaging up is tricky when it comes to options due to the Greeks' implied volatility. So if your stock is moving, your implied volatility is rising along with the Greeks, and any sort of adverse move can turn your position red. Averaging up is largely not recommended for options unless it's with leaps and during minute moves in the underlying. So with that being said, leaps are they're kind of immune to any sort of little blips, I guess you could say. So that's kind of okay to average up with leaps. But when it comes to a day trade or like a swing trade, averaging up, that's one way that you can start losing. Your position a winning position can turn into a losing position rather quickly. So we kind of want to avoid that. So averaging down using charts. So as stated on the previous slide, ideally, we want to average down at support. So if our position is a swing position, we want to average down at support on 1 hour to daily timeframes, depending on how long you plan on holding. If our position is a day trade or scalp, we want to average down at support on the shorter timeframes, so the 5-minute, 15-minute. But we should also pay closer attention to the larger timeframes, as those levels are still more significant. So this is effective for trying to find a place to break even or even profit off of a losing position. So we should monitor both long-term and short-term, but long-term is more significant, I would say. Your incentive has changed. Let's say if you were originally in a position for a day trade or scalp and you got caught in it, the incentive isn't to scalp, it's to get out at break even. So we can kind of pay closer attention to both timeframes in that situation. Also, before averaging down at support, we want to wait for a confirmation of a bounce or turnaround. Otherwise, if support breaks, we just add more premium to a losing position. So we definitely do not want to do that and want to avoid that at all costs. So averaging down using order flow. So order flow can help us determine if averaging down is a good idea. So if we're seeing repeat calls or puts at support, we may want to follow that flow. So for example, if we currently have a call that is down and we're starting to see repeat calls come in for that ticker, this could be a sign to average down on our current call position, especially if order flow coming through the tape is similar to our position in terms of strike price and expiry. However, if we are seeing puts come in for that ticker and we have a call that is currently down, it may not be a good idea to average down, as we are likely going to take a larger loss than originally planned if we decide to average down regardless of the put flow. So order flow analysis must be combined with technical analysis before averaging down. Like with any trade, the chart setup must also be there. So we need to use Confluence. We need to look at order flow. We need to look at the chart. We need to make sure everything is in place. The setup is there before we start averaging down on a losing position. So here is an example with stocks. So for example, let's say you own 100 shares of Apple and you bought at $125 per share for a total of $12,500. So this is in your long-term portfolio. You have 100 shares of Apple and you plan on holding forever. So we know that Apple already is a strong financial company and we plan on holding shares for years to come. However, shortly after we buy Apple at $135 per share, Apple sells off back to a low of $115 a share. Now, because we are planning on holding Apple long-term, we aren't too concerned about our entry in this example. However, we also see an opportunity to bring our average cost of our share position down, which we deem low risk because we plan on holding for so long and Apple is just such a strong financial company. So we really don't hesitate, and this is a low risk, high reward strategy. So we decide to average down on our Apple position at $115 a share and add another 100 shares, which brings our average cost down to $120 a share. So from a technical analysis standpoint, we could see that Apple's structure on the daily chart was bullish, making higher lows and higher highs. We can also see a double bottom in a financially strong company, indicating a bullish reversal was imminent. So after averaging down, Apple rallied and hit a high of $151.83 a share 4 months later. So we have no expiry, we have no Greeks, we have nothing to worry about in this example. We are just averaging down on a long-term portfolio. So had we just kept our original position, our position would have went green anyway, and we would have made $2,683 in profit. However, because we averaged down and added an extra 100 shares and also bringing our average cost down, we made $10,366. So you can see for the long-term portfolio, averaging down, especially in strong companies, is a great strategy to build wealth. So I highly recommend it when it comes to your long-term portfolio with blue chip companies. Here is our options example, which is a little bit different. So for example, after Microsoft broke its all-time high, you've identified a high probability setup on Microsoft as you believe Microsoft has more upside and decide to buy a call with a 310 strike, September 3rd expiry for $224 a contract. I should also add that the date of this order was executed on August 20th. So we'll keep that in mind. So your IV and the Greeks upon purchasing the call are as follows. So you have the IV, the implied volatility, pretty much 18%, delta 31%, gamma 3%, theta negative 19%, vega 22%. So after purchasing the call, Microsoft pulls back to 304.20 from your entry price of 305, temporarily bringing your swing red. But we decide to hold and see what happens from here because we are bullish on Microsoft. The week after entering our call position on Microsoft, it actually breaks bullish structure and sells off all the way back to 297.62. So that's pretty much that's close to like 100% loss there. That's a bad loss. So from here, we have two options. We can sell at a loss and just call it a day, put that premium that we've salvaged, if any, into a winning trade, or we can try and average down at support to get out. So if we decide to average down here, the incentive is to get out at break even or profit, and therefore we will need to buy more than just one contract. So although super risky, we decide to assume the risk and buy 30 contracts for 15 cents a contract, bringing our average cost to 21 cents a contract. So soon after we average down, Microsoft bounces off support, as you can see, and it hits $299.64 a share. So it hasn't quite taken back 300, but it was a hard bounce, as you can see on the 1 hour chart. So once Microsoft hits $299.64 a share, these contracts go to 25 cents a share, turning our position green and just above break even. So this is our chance to get out at break even and get our original premium back. So by averaging down, we also affected our Greeks, bringing our Greek values down with it. So the implied volatility has increased, as you can see. That's just because of more movement. But the delta is now only at 4%, gamma 1%, theta 6%, vega 4%. So once we averaged down at support and we got that move, all of these numbers obviously increased. And it also helped bump up our premium and get us out of a losing position. So that's the end of the lesson, guys. Thank you for watching all about averaging down. So hit that like and subscribe button. Follow TradePro Academy on Twitter. You can also follow myself, Sarachika Trades, Trading with G, which is George, and Torio Trades, which is Victorio, on Twitter for all market updates. We post a lot of our positions there. We post our analysis. It's a great way to keep updated with the TradePro community. And you can also trade with us live at community.tradeproacademy.com. So we hope to see you all there. Thank you for joining me today, and can't wait to see you all at the next lesson. Have a great day, everyone.